What's up, everybody? John Grauman here with another market update for you as we head into Q3. Lots going on, lots to unpack, so let's jump straight in. As many of you know, the Fed raised interest rates again a few weeks ago, this time by 3/4 of a basis point. They have announced that it's expected they're going to raise rates again this July, probably once more in the fall, and maybe again in December. So we may have 3 more rate hikes coming before the end of the year. Now, let's talk about how that relates to actual mortgage interest rates. Well, we're actually seeing a bit of an inverse right now between conforming loans and jumbo loans. These are loans that are based on certain price points and thresholds. In the conforming market, where the loans are government-backed, you're seeing rates right now that are 5.5%, 6%. In the jumbo arena, where they're oftentimes what are called portfolio products, meaning it's the bank lending their own money, the banks are being a little bit more aggressive and lending rates in like the 4.5% to 5%. Even though we've seen rates in certain instances double since the start of the year, we haven't seen an immediate impact in home prices. You have to remember, real estate is a slow bleed. So just because rates have gone up by 1, 2, sometimes 3 points doesn't mean that it's going to have an immediate impact on prices. That's just not the way real estate works. It takes a little while for it to settle in and adjust to the new norm. What typically happens is we're going to see a dip first in the volume of transactions, and once that happens, or as that happens, then we'll start to see some type of adjustment in home prices reflective of whatever the new demand is once we reach that point in time. I often think it's helpful to look back a little ways to understand what's happening right now. Again, remember, at the beginning of the pandemic, the Fed slashed interest rates to zero and invested trillions of dollars into the economy by buying up bonds. This gave way to hyperinflation, which is what we're seeing right now. Inflation's at the highest point we've seen in 40 years. This created sort of an artificial market, if you will, where we had the lowest interest rates in history, we had the highest spike in home prices in history, and it was a bit of an aberration. So if we see home prices start to adjust a little bit, that's just the market leveling out and balancing, which is what markets do. It's kind of physics at its core. What goes up must come down. It's gonna balance itself, so don't be scared or afraid if you see a little bit of shift or adjustment in home prices. I don't know that it's quantifiable yet. The market is literally shifting beneath our feet, and until it finds its footing, it's going to be difficult to get an accurate gauge on things. There's definitely a sense of hesitation in the market. It's palpable, it's just not quite quantifiable yet. A different way of saying that is that if there's going to be a hit to home values, it's ultimately going to be predicated upon how high interest rates go and how long they stay there for. We have a pretty good sense of an answer to the first question. We know that they're in the 5.5%, 6% range now and are probably likely to see the 7s, maybe even touch 8 before the end of the year. How long they stay there for is going to be dependent on how long it takes the government to curb inflation. Keep in mind, this is all by design. As I said before, the government is putting the economy into a temporary nosedive to try to curb inflation. It's a rather steep nosedive because they're trying to get ahead of it quickly so that we can get out of it quickly. So, what does this mean for you and where's it all going? Well, frankly, that's anybody's guess right now. And I find these days a lot of people are getting their crystal balls out and trying to play Nostradamus, but the reality is none of us know for certain because none of us have ever been here before. And if you look at a lot of the big key indicators going in the opposite direction of what you would typically see in a normal recession. For example, the cost of commodities and materials has recently gone down. Unemployment is still very low. So it's kind of anybody's guess where this may go. What I can tell you is that real estate is going to continue to transact. Why? Because of life circumstances. People are going to get married, people are going to have kids, people are going to get divorced, people are going to die, people are going to get new jobs, people are going to have to move. All of that necessitates the buying and selling of transactions in real estate. So it's important to stay informed, please stay tuned, and if there's anything we can help you with, don't ever hesitate to reach out.